Okay, I want you to close your eyes for a second. Just transport yourself back to 1985. Back to the Future is absolute crushing it at the box office. Everyone is wearing neon. And if you looked at the absolute pinnacle of the American economy, the king of the hill, it was IBM.
Big Blue, yeah. The ultimate symbol of, corporate stability.
Exactly. It was America's most valuable company, incredibly profitable. But here's the number that really frames our whole conversation today. IBM wasn't just a logo. It was a massive ecosystem. They had a payroll of nearly 400,000 people. I mean, if IBM did well, a whole city's worth of families did well. They bought houses, cars, the wealth spread out.
It was the classic model, right? The mid-20th century corporate model. Success meant scale, and scale meant bodies. If you wanted to make more money, you generally had to hire more people.
Right. So, snap back to today. Who is the new titan? The company everyone's watching. NVIDIA, the chip maker that's powering this entire AI revolution. And, looking at the numbers in our deep dive, adjusted for inflation, NVIDIA is nearly 20 times as valuable as IBM was back then. It is 5 times as profitable. But here is the stat that it stops you in your tracks.
It's the employment number.
It's the employment number. NVIDIA employs roughly 1/10 as many people as IBM did.
It's a staggering efficiency ratio. I mean, you're talking about an entity that generates just exponentially more wealth with a fraction of the human footprint.
And that comparison right there, that's the hook for our deep dive today. We aren't just comparing two tech companies. We're looking at a fundamental rewiring of the economy. It feels like the rewards are flowing, disproportionately to capital, the shareholders, the algorithms, while labor, the actual human beings, are getting a smaller piece of the pie.
And it's important to say this isn't just a vibe people have, it's a structural divergence. This split explains why the headlines can say the economy is booming with record GDP, while the average household feels, pessimistic and squeezed.
It's a disconnect.
It's a huge disconnect, 40 years in the making. And if the research we're covering today is correct, AI is about to pour gasoline on that fire.
So our mission is to unpack this divergence. We need to get into how we got here, why the rules have changed, and why your paycheck might be fighting a losing battle against the stock market. Let's start with the basics, because capital versus labor can sound a little dusty.
A bit like a textbook, yeah.
Right. So when we say money's going to capital instead of labor, what does that actually mean? What does it look like in the data?
Okay, to see it, we have to look at something called the labor share of income. So think of the entire economy as one giant pie.
I'm always on board with a pie analogy.
Good. So that pie is your GDP, your gross domestic income. Every year, we bake this pie, and then we have to slice it up. And broadly speaking, there are really only 2 main groups waiting for a slice.
Okay.
One group is labor. That's everyone earning a wage, a salary, benefits. It doesn't matter if you're a janitor or a CEO, if you work for a paycheck, you are in that group. You are labor.
And the other group?
That's capital. That slice goes to corporate profits, to interest payments, dividends, to shareholders. It's the money paid to the people, or, the entities who own the assets. The machines, the buildings, the stock.
Okay, so in a healthy economy, you'd think that split would stay pretty stable over time, right?
Historically, yes. It used to be one of the great constants in economics. But here's where the shift happens. If you look at the data from 1980, labor got about 58% of that total economic pie.
More than half.
More than half. But by the third quarter of last year, that share had plummeted to 51.4%.
Okay, but hold on. I could just hear someone listening and thinking, 58% down to, 51.4? It's less than a 7% drop. That sounds like a rounding error, not a crisis.
It sounds small in percentage terms, but you have to apply that to the scale of the U.S. economy. We're talking about a GDP of roughly $27 trillion. So a 6 or 7% shift represents trillions of dollars every year.
Wow.
That's money that used to go into workers' pockets for mortgages, for tuition. That's now just bypassing them entirely.
And where's it going?
Straight to the other side of the ledger. The profit share, the slice for capital, it rose from 7% to 11.7% over that same period.
So it's a direct transfer.
It's a massive transfer of wealth. It's not disappearing. It's just moving from the pockets of workers to the accounts of shareholders.
So the obvious question is why? I mean, did something mechanical just break in the 80s?
Well, the research points to a few catalysts. You had the decline of unions, which that took away bargaining power. You had globalization, outsourcing. American workers were suddenly competing with cheaper labor abroad.
Sure, that makes sense. If you can move the factory to a place where wages are $2 an hour, the domestic labor share is going to drop. But the sources we're looking at today, they point to a different culprit, one that feels very, very relevant now.
Automation.
Automation.
This is the key factor. There's a landmark study by Pasquale Restrepo at Yale and Darren Acemoglu at MIT, and they ran the numbers. They found that automation explains about half of the drop in labor share between 1987 and 2016.
Half. So that's actually more impactful than the outsourcing story we always hear.
In many sectors, yes, and you can see it so clearly in manufacturing. In 1980, if you looked at the value a factory created, 66% of it went to the humans working there.
Okay.
But as robot arms replaced welders and automated lines replaced assemblers, that share dropped. By the 2000s, it was down to 45%.
But isn't the standard argument that, okay, automation makes things cheaper for everyone. We get cheaper cars, cheaper TVs. Doesn't that balance it out?
That is the trade-off. Productivity went way up. The capital side, the owners of the robots, made more money. We, the consumers, got cheaper goods. But the workers who were displaced,
Right.
They were pushed out of high-value manufacturing jobs and into often lower-paying service jobs. So while you might get a cheaper toaster, your actual ability to buy it might have gone down.
So capital captures the gains, labor loses leverage. That seems to be the pattern.
Precisely. And that brings us to the modern era. Because if the 80s were about physical robots in factories, today we are dealing with a totally different beast. We're talking about the rise of intangible capital.
This is a term I've seen popping up more. Help us distinguish this. Back then, capital was tangible. A blast furnace, a fleet of trucks. You could kick it.
Correct. And physical capital has a limitation.
Yeah.
It's hard to scale. If Ford wants to double its truck production, it has to build a second factory, buy more steel, hire more people. There's friction. But for the big tech giants today, Google, Microsoft, Meta Capital, is intangible. It's algorithms, it's source code, it's user networks.
And the magic of that stuff is that it copies for free.
Zero marginal cost of replication. I mean, if Google writes a search algorithm, it costs the same whether one person uses it or 1 billion people use it. They don't need to hire more search engineers just because search volume goes up.
That explains the superstar company phenomenon, the NVIDIA thing we started with. Let's look at Alphabet, Google's parent. The data shows that in the past 3 years, their revenue grew 43%. Massive growth. But their headcount?
Flat. Statistically, zero growth in the workforce.
That's wild. 43% more money coming in and 0 extra people needed to manage it.
And Amazon is really the only partial exception because they have to move physical boxes. But even they are aggressively automating those warehouses. So the big takeaway is that these dominant companies can generate massive wealth without mass employment. They've decoupled revenue from headcount.
There's also this weird blurring of the lines, isn't there? I mean, you're a top researcher at OpenAI or a senior engineer at Google. Are you really labor in the old sense?
That's a great point, a great nuance. In this new economy, that top tier of employee is seen almost as a form of human capital. They aren't just paid a wage, they're paid largely in stock. They own a piece of the capital.
So they've been invited into the VIP lounge while everyone else is still waiting outside.
And companies will pay just astronomical sums to acquire this human capital. Look at what Meta did recently. They paid roughly $14 billion for a stake in a company called Scale AI.
$14 billion. That is the GDP of a small country.
And a huge part of that valuation was just to lock in the founder, Alexander Wang, and his team. It's an acqui-hire on steroids. They're buying talent like it's an asset. So for the superstars, the system works great. But for the vast majority of workers, the picture is very different.
Which brings us to the post-pandemic world, because I think this is where a lot of listeners feel that disconnect viscerally. We keep hearing the recession didn't happen, soft landing, but the vibes are just off.
The data supports those vibes perfectly. If we look at the numbers since the end of 2019, right before the pandemic, workers' wages after inflation are up about 3%. Total compensation up about 8%.
Okay, so a modest increase. Not terrible, but hardly a boom time.
Now look at corporate profits over that same period. They've climbed 43%.
Whoa. 3% wage growth versus 43% profit growth. That is the definition of divergence.
It is. And when profits go up that much, stock prices usually follow. So we've seen the market hitting these record highs, the Dow crossing 50,000.
But here's what I don't get. If wages are barely moving, how is the economy still chugging along? Who is buying all this stuff?
This is where it gets really fascinating. It's a phenomenon called the wealth effect. Because the stock market has gone up so much, the value of household stock wealth is now nearly 300% of annual disposable income. That's up from 200% just in 2019.
But wait, Doesn't only a small percentage of the population own the vast majority of stocks?
It is concentrated, absolutely. But that top tier, the affluent households who own the bulk of the stocks, they drive a huge chunk of consumer spending. There's a quote in our research from Doug Pita at BCA Research. He estimates that a 10% return in the stock market boosts spending capacity as much as an 18% rise in income.
Wait, say that again? A 10% stock market bump is like giving everyone an 18% raise?
In terms of spending power, roughly yes. Because those asset holders feel richer, they spend more freely, so the economy doesn't need broad-based wage growth to keep moving as long as stock prices keep going up.
That sounds precarious. Like the economy is running on asset inflation instead of income health. We sort of decoupled the economy from the paycheck.
It certainly makes the system more fragile. It means we're reliant on high valuations to keep the consumption engine running. PETA's argument is that these high profit margins aren't going to revert back to normal. He basically said the low profit margins of the past aren't coming back any more than the 3 martini lunch.
I get the point. We're in a new paradigm where high profits and high stock values are the engine, not necessarily wages.
Correct. And if you think that shift was a big deal, we have to talk about what's coming next, because the divergence we've seen so far might just be the warm-up act for AI.
This is the part that makes people anxious. We talked about automation hitting factories in the 80s, but the narrative has always been, go to college, get a white-collar job, you'll be safe. AI isn't coming for the blue-collar jobs this time, is it?
No, it's coming for the office. It's coming for the knowledge workers.
Our source quoted Dario Amodei, the CEO of Anthropic, and he made a distinction that really stuck with me. He said AI isn't just a substitute for specific tasks, it is a general labor substitute.
That is a profound distinction. A welding robot is a tool. It does one thing. But a large language model is flexible. It can write code, analyze spreadsheets, write marketing copy. It acts more like a person than a tool.
So Amadei's point is that we might not just see certain people get fired, we might see the nature of the company itself change.
Exactly. Imagine a company today that needs 500 mid-level employees to manage data and compliance. In the near future, a competitor could start up using AI agents to do 90% of that work, with maybe 10 people overseeing the AI. You replace labor-intensive enterprises with automated ones.
And we're already see the market react to this. When Anthropic unveiled tools for synthesizing data, what happened to the stocks of specialized service companies?
They tanked. Stocks for companies that provide, outsourced legal help or call center services, they dropped immediately. The market realized, oh, we don't need a specialized human firm for this anymore. The AI is good enough.
So we are looking at a white-collar squeeze?
That's the term. We're referencing Pasquale Restrepo again here. He predicts that just as blue-collar wages suffered from factory automation, white-collar wages are next. The logic is brutal but simple. If a machine can do your job cheaper, your bargaining power for a higher wage it evaporates.
So in this new world where capital, the AI models, the servers reign supreme, who are the winners?
Well, ironically, the labor winners might be the jobs AI can't do yet. Things that require social skills, empathy, physical proximity, plumbers, nurses, caregivers, they're incredibly hard to automate.
And consumers, I guess.
Yes, in theory. If legal advice becomes 99% cheaper because of AI, that's a massive benefit. Services could become incredibly cheap. But the biggest winners...
Let me guess. The people who own the AI.
The shareholders. Capital. If you own the machine that generates value without the labor cost, you capture all the upside.
It's a complete reversal of the IBM model we started with. We've gone from an economy of mass employment to one of massive efficiency, where these value-generating engines barely need us to run them.
And it creates a paradox. We've built an engine that is incredibly efficient at generating wealth, but it's breaking the primary mechanism we use to distribute that wealth, which is wages.
So what does this all mean? It seems clear the divergence isn't a glitch, it's the defining feature of the modern economy.
It is the trajectory we are on. And that brings us to the final, somewhat provocative thought I want to leave our listeners with.
Go for it.
If we are moving toward a future where capital is triumphant, where companies can generate almost infinite value with almost zero labor, we have to ask a fundamental question. What is the role of the average human in the economic engine?
That is the heavy hitter.
If you can't sell your labor for a good wage because capital can do it better and cheaper, how do you participate in the economy? We have built an entire society based on the idea that you work to eat. But we're building a technology that potentially removes the need for a lot of that work.
Is our current structure even sustainable in that world?
That is the question.
It's not just about economics anymore. It's about Yeah, how we structure society. That is a lot to process, but it's the question we need to be asking.
Precisely.
Well, on that existential note, we are going to wrap up this deep dive. We hope this gave you some clarity on why the economy feels the way it does, even if the stock market says it's a party. Thanks for listening.
Thanks for joining us.